So if you're a young professional, chances are you've bumped into Salesforce. It's kind of the engine running behind the scenes at so many companies, right? But today, we're not looking at it as a user. Nope, we're putting on our investor hats. We're gonna look under the hood of this tech giant, and what we find might actually surprise you. And really, the big question for any investor looking at Salesforce today is this. Is this a company whose best days of crazy growth are in the rearview mirror? A mature giant, just kind of settling in? Or is this whole AI revolution about to crown Salesforce a king all over again, unlocking a massive, massive new chapter of growth? That's the real tension we're going to dig into. All right, let's kick things off with the bull case, the super optimistic view. This argument sees Salesforce not just as a company with some strong defenses, but as a fortress that just got a whole new arsenal of AI-powered weapons. And the foundation of it all is its incredible fortress. Now, for any long-term investor, one of the most important ideas is the economic moat. Seriously, just picture a castle. A wide moat makes it incredibly difficult for invaders, or, in this case, competitors, to attack and steal your profits. The wider that moat, the safer the castle. It's that simple. And it's not just us saying this. Check out what the analysts at Morningstar have to say. They use very specific language. They don't just say Salesforce has a moat. They assign it a wide economic moat. And believe me, that is the gold standard for investors. And they say it comes from two main things: switching costs and something called the network effect. So let's break down what this wide moat actually looks like in the real world. First off, the switching costs are just astronomical. Once a company builds its entire sales and service process on Salesforce, ripping it out is like performing open-heart surgery on the business itself. It's not just software, it becomes the central nervous system. That's why 90% of the Fortune 500 are clients, and why they keep about 92% of their customers every single year. It's incredibly sticky. Then you add in the network effect from over 5,000 apps on their app exchange, and it just gets harder and harder to leave. But look, a great defense only protects what you already have. To really win, you need a powerful offense. So the big question for us as investors is, where is the new growth going to come from? Well, the answer is pretty simple: AI. 169%. What in the world is that number? Well, get this. That is the staggering year-over-year revenue growth for Agentforce, Salesforce's big AI platform. We're not talking about a little incremental growth here. This is an absolute explosion. And this is where their AI strategy gets really, really smart. See, the old model was simple. You have more salespeople, you buy more licenses or seats. Your revenue was basically tied to how many humans you employed. But the new AI model, it flips the script completely. They charge based on consumption for every single task the AI completes. This totally decouples their revenue from the number of human employees. It means their potential revenue from each customer isn't capped by headcount anymore. This is a potential game changer for their whole business model. And you can just hear the excitement in the CEO's voice. Mark Benioff himself calls these AI products the momentum drivers, pointing out an explosive gain. This tells you it isn't some side project. He's telling Wall Street that AI is now the very heart of their growth story. Okay, that all sounds fantastic, but you know us, a smart investor always looks at the other side of the trade. So now we have to consider the bear case. Are there some storm clouds gathering on the horizon that could threaten that shiny fortress? Yeah, the biggest threat here isn't some scrappy little startup. It is one of the largest, most powerful companies on planet Earth, Microsoft. And they are coming right for Salesforce's crowd. This table gives us a fantastic snapshot of the battlefield. Salesforce is the clear number one, no question, with over 20% of the market. But look at Microsoft. Their key strength is bundling. They can package their CRM, called Dynamics 365, with Office 365, which, let's be honest, nearly every company already pays for. So for a cost-conscious executive, getting a good enough CRM at a massive discount is a very, very tempting offer. And you can't sleep on the others either. Oracle and SAP are hitting them from the back office, and HubSpot is snapping up all the smaller next-gen companies. So let's just nail down the bear case. First, the core business, if you take out that explosive AI stuff, has slowed down a lot, from over 25% growth a few years back to around 10% now. That's a big deal. Second, that Microsoft bundling strategy is a serious, serious threat. And third, AI is kind of a double-edged sword. Sure, Salesforce is using it, but new AI-native startups could pop up and offer similar features for way cheaper. All this adds up to one major risk:
the market could stop seeing Salesforce as a high-growth tech star and start treating it like a slower, more mature company.
So, we've got the bull story, we've got the bear story. Now let's get down to brass tacks. What are we actually paying for, all this potential, and all this risk? It is time for a valuation reality check.
This is the key number we have to unpack: 20.8 times. This is Salesforce's current price-to-earnings ratio, or PE. And in simple terms, all that means is that investors are willing to pay about $21 for every single dollar of the company's annual profit. So the big question is that cheap or is that expensive?
Well, context is everything. As this chart shows pretty clearly, compared to the wider software industry, which averages over 30, and its direct peer group, which averages over 42, Salesforce's PE of around 21 actually looks pretty reasonable. So what this really tells us is that, on a relative basis, the stock doesn't seem wildly expensive. It looks like the market is already pricing in some of those bear case risks we just talked about. And that could be an opportunity if you're a believer in the bull case.
And beyond just the valuation, the company's financial health is just rock solid. We're talking over $41 billion in annual revenue. But look at that non-GAAP operating margin. At over 35%, it shows this isn't just a growth story, it is an incredibly profitable, cash-gushing machine. We're talking over $12 billion a year in free cash flow. That's real cash.
So where does all this leave us? Let's try to pull this all together for a final take. Now, my goal here is not to give you a buy or sell call, but to give you the tools and the framework to make your own informed decision.
You know, it really just boils down to this fundamental conflict. The bulls are going to point to that wide economic moat, that insane AI growth, and a valuation that looks pretty good next to its peers. The bears, on the other hand, are going to focus on the fierce competition from Microsoft, that undeniable slowdown in the core business, and the risk that AI could actually disrupt Salesforce itself. So if you're watching this stock, here are 3 key things for your investor toolkit. Number 1, keep your eyes glued to that Agentforce revenue number. Is it continuing to grow like a weed? Number 2, watch the operating margins. Can they stay this profitable even as they pour money into AI? And number 3, watch the competition. Check those market share reports. Is Microsoft actually gaining ground? And this all brings us to the final big question. This is really what the entire investment thesis hinges on. Will Salesforce successfully use its massive data advantage to build an unbeatable AI empire for the next decade? Or will that fortress, which seems so strong today, be rendered obsolete by nimble new AI competitors and giants like Microsoft? That is the multi-billion-dollar question you have to answer for yourself. And hey, just a quick final reminder, of course, this explainer is for informational and educational purposes only. It is absolutely not financial advice. All investing involves risk, so please always do your own research and consider chatting with a licensed financial professional before making any investment decisions.